All right, well, thank you all for coming here this morning. I have to first apologize that I've been told that the air conditioning caught on fire last night, so it's going to get warm in here, so please feel free to take off your coat, unbutton your first button. We can't go Miley Cyrus in here, but we can get a little creative.
Get close.
We've got also on the phone, hopefully most of the TNAHU members are dialed into an audio conference and hopefully participating via Adobe Connect, so a webinar. This is our first time being able to push this information over the web, so hopefully, fingers crossed, it's going to go well with that. And as soon as we get everybody seated, we'll go ahead and start the day with the prayer and the pledge. I don't know if anybody saw on the news this morning on your way in that they've actually moved the employer mandate back to January 1st, 2014. Supposedly, Russia called and said they could administer it. Edward Snowden said, you know, it could have been done the whole time. So, all right, again, thank you all for coming here. If you all bow your heads, please. Heavenly Father, thank you for bringing everyone here today safely. Please guide our hearts as most of us retool for an entirely different way of doing business. Be with those that are struggling to find direction and comfort with the many changes that have been laid at our feet. Help us remember that our faith in you will provide us with direction and purpose. Thank you for the many blessings you have given us and for the friendships within our organization. Be with those that are less fortunate and protect us as we all go our separate ways after this meeting. Amen. All right, everybody, please stand, face the flag. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. We're going to kick off this meeting with an award for our very own Brent Watkins. He was our past president before Austin Madison, and I'd like you all to join me in thanking him for his time and his service to MTAHU. Thank you very much.
So I get the honor of passing the torch to Justin here. Austin couldn't be here today, and he asked me yesterday afternoon to step up. Otherwise, I would have had a big speech for him because he's been a board member, I guess, for 4 years now, 4 years. And he's kind of the dream board member if you're serving in a leadership role to have. He's pretty much carried the load for all of us for the last several years. He's made huge improvements to our technology and communication. Those are just two of many things that Justin's done. So I'm really glad to have him in the leadership role this year, and I'm hoping everybody will step up and volunteer to help him like he's been helping this organization for so long, not just our chapter, but other chapters throughout the state. He's been a big help too. So everybody, let's give Justin a hand to kicking us off for the year. Thank you.
So what we've got today is a action-packed day of, we got very intelligent, well-educated individuals sitting in front of me. We're going to have a panel discussion. Again, it's going to be broadcast over the internet. We're excited to announce that this new technology exists. We hope that it'll grow our membership, that those folks that can't be here in person will be able to dial up using their mobile devices. We've revamped the entire website, mtahu.org, so please feel free to check us out online. There also has been some updates to the way that we're collecting funds for our political action committees. We all know that it takes money to drive the people that make the decisions and vote on our behalf in Washington and in Tennessee. So please feel free to check that out online, mtahu.org. Go to the donations page, and read through that. I think that's some great information that's out there. All right, at this point in time, I'd like to call up Beth from Cigna. She's our sponsor, and we'd like to thank them for sponsoring today's event. She's got some information. She'll spend a couple minutes telling you about that, then we'll jump right into the meeting.
You do just like the prom.
You got it, just like the prom. Get a fold in there. All right.
Thank you. Can everybody hear me? Thank you for having us. My name is Beth Begley. I'm with Cigna Individual and Family Plans. I'm the new business manager for Tennessee. Many of you here in the office already, in the building already work with us with their individual plans. I wanted to give you a quick overview of our plans for this fall and what's coming up. As you know, Cigna Individual is in 10 states now. On 5 of those states we will be in the marketplace. Tennessee is one of them. We've had a lot of questions this morning. We will be on and off the marketplace in Tennessee in 3 of the service areas, Nashville, Memphis, and Chattanooga. Those of you that are in group and have opportunities coming up to move some of those folks to individual, please feel free to contact me. I did want to make just a couple quick points. We wanted to let you know that our strategy for our existing book of business, Cigna will be auto-renewing anybody. We're going to offer auto renewal to anybody who's currently enrolled or enrolls through the end of 2013 to make it easier for the brokers to not have to deal with that population. We're also going to be offering some very good information, some analytics and recommendations as to which of your customers would benefit by staying on their existing plan to avoid that huge rate shock, and which might benefit by moving to a new plan, whether they'll have something new covered or they may qualify for a subsidy. So we're going to make recommendations where we can. Our motto is delay the pain. We're going to allow anybody who can to keep their existing plan at the potentially lower rate through the end of 2014. So we can help you with those strategies. We also have a couple of additional strategies for making money this year and helping your clients this year. We've offered a new critical illness product, which is a lump sum cash payout. Very low premiums, very high commissions, 85% first year commissions. So talk to me about that. You don't have to sell it with medical. It can be sold standalone or in a group. So we've got that going for folks to generate more revenue streams. New for 2014, we're going to have 3 new standalone dental plans that can be sold to any age. Children standalone, over 65. You can sell it standalone to former groups or groups that aren't offering dental. So let us know how we can help you on standalone dental. New for 2014, shifting gears, we will be on the exchange, and we've got an all-new suite of plans that we will be selling on and off the marketplace, including dental on and off the marketplace. What's coming back, in case you weren't aware, underwriting is going away, child only is back, maternity is covered. We can actually sell to over age 65 if for some reason somebody doesn't qualify for Medicare. So new markets for us. If you're in the senior market and you're selling to seniors, we now have a great solution for those trailing spouses. They don't have to pass underwriting, they'll have a rate advantage. So talk to us about those. I guess the good news is everybody's a prospect for individual medical. We don't have to say no to anybody next year, and some may get financial aid, as you know, assuming everything's working well in just a few weeks here. Our phones are ringing. People are calling to ask. There's going to be a lot of, the federal government is going to be doing a lot of advertising, so your phones will be ringing too. I guess the key takeaway is we can help you for 2014, but ask a couple questions, because there may be good business that you can get in 2013 and do your customers a service by protecting them from that rate shock. So again, our motto is delay the pain as long as you can for those that would benefit by enrolling this year. Our other motto is we've got your back for our brokers. We're doing everything we can to make this transition easy for you. We're making huge investments in technology. We are assisting with things like the renewal process to try to make your life easier. And for those of you that are going to be new to us because you're just coming into the individual market, that's my job, is to get you appointed, get you trained, and make it easy for you to do business with us. So our advice to you to be successful in 2014 in the individual market is become an expert, finish your certification, and let people know you can help them. Spread the word, shout it from the rooftops, because somebody else will help them if you won't. We do have one other item. We talked about our investment in technology, and you know all the uncertainty we've been talking about. So Cigna has invested in a lot of funds, and we came up with the Cigna Healthcare Reform Predictive Modeling System. We use this at our broker meetings, and somebody would say, exactly what's going to happen with the all will be revealed. So if the panel needs this, it's available to answer any of your questions today. Thank you very much. We appreciate your business.
We can just put that right here.
Yeah. All right, so we get technology up and rolling here. All right, to kick off the meeting, we've got a quote by John F. Kennedy. The Chinese use 2 brushstrokes to write the word crisis. One brushstroke stands for danger and the other for opportunity. In a crisis, be aware of the danger, but recognize the opportunity. I think that speaks volumes to our industry at this point in time. With that said, as I mentioned earlier, we have a board of individuals in front of us that are going to put us on the track to be able to take advantage of this change in our market, to have strategic objectives, to listen to not only the voices that are happening here in Middle Tennessee, but these folks are well versed across the country. So what other people in our industry are talking about, what other employers are talking about. So today's going to be a great meeting. We do have a couple of housekeeping items to go over. We've got a lot of educational information to bring to everyone today. Again, this is our first meeting using this technology, so please be patient, especially if you're dialed in across the state on the teleconference line. We have placed you on mute, and we will pick you back up at the end if we do have time to do that. If you aren't seeing a slide deck, if you're dialed in, you can go to mtahu.org/events and click on the words "click here" to view this presentation. At this time, please silence any cell phones if you haven't already. We have Tennessee members, again, logged in, so when we're responding to the questions, just be cognizant of the fact that they're trying to listen, and so speak loudly and clearly if we would. And in order to keep this meeting moving forward, we're going to limit each comment from you all to 3 questions from the audience per topic, and we'll come back and we'll re-review that if we have time at the end, because we want to cover all this material. In the event we do not cover all of the topics, what we're going to do is post them on our LinkedIn group page. So we're going to create that online discussion that will occur from this point forward for all future meetings as well, to bring people to that website. So it's not more of a monthly meeting, it's more of a daily and hourly and meetings that's in real time. With all the changes that are happening in our industry right now, it's important that we all stay in communication so we can help each other out. With that said, I'd like to introduce, I guess starting from from Buddy on the very end, back down there, from Boyce & Associates. He is a broker, as many of us are in this room. And Buddy, I don't know if you wanted to say a couple things about you, or if you wanted me to paraphrase.
Glad to be here. I've been doing this since 1989, just a few years. I started when I was about 4 years old, and seen an incredible change in that landscape when I started and where we are today. I've been all over the country trying to learn this stuff, from San Diego and Las Vegas, Atlanta, to different national conferences, and glad to be here to share what I'm hearing. A
All right, and next to him, George Brandis.
So, hi everybody. I'm also really pleased to be here, and I'm a native Tennessean and work for the governor, running his insurance exchange with Brian Hale, who's somebody you may have met and gotten to spend some time with. And Brian and I have since moved on to Jackson Hewitt Tax Service, which is the second largest national tax preparation company in the country, where we're implementing a program to use the tax industry as a vehicle for enrolling people in the new insurance affordability programs. So I'm just pleased to be here and look forward to some interesting discussion.
Ms. Anderson.
Hi, I'm Kari Andersson. I'm with Cigna. I'm pleased to be here, though Justin did not mention the camera and the broadcasting part before I signed up, so it's a little unnerving as I'm sitting here. But so I'm a sales manager at Cigna for what we call our Select segment, which serves employees or employers with 25 to 250 employees. And I've been in the market for a year, just a little over a year, but I've been with Cigna for 12 years, spending time in our home office up in Connecticut.
Mr. Jeff Miles.
I'm Jeff Miles, and I guess I'm glad to be here.
You don't have to be.
I'm 35 years in the business as a personal producer. I've been here in Tennessee for 2 years, where I moved from California. My business is all there, so I don't compete with any of you. I study these issues nationally, and I'm hoping to bring you some perspective on what it looks like in other places besides just here.
Great. Thank you all for being here. We really appreciate it. We're going to jump into some topics that we polled you all and across the state as well, other TNAHU members, of things that were concerning them, some things that they want to learn more about. And I guess we're going to jump into the first one. We're going to get Jeff back on the microphone, and I'm going to read these out because they don't have them in front of them. What are some of the pros and cons in getting a client on a policy that starts in October, November, or December to avoid the changes effective as early as January 2014?
Well, I'm a big proponent of making an early change. In my market, where I have all my clients, we also have 10 carriers. So it's a very competitive business out there, unlike it is here in Tennessee. As a result, carriers have all aggressively reached out to the broker community and said, don't be a fool. Move your people early. They've shown us what some of the rates are going to look like in 14 versus what final quarter of 13 rates are going to look like. So they've made it relatively easy for us to see. With all of the various problems that we know about and the countless number of problems that we haven't even thought of yet that this whole rollout is going to entail, I'm of the belief that regardless what the finance aspect of it is, it's a good idea for employers to get on the sideline. Get on the sideline and watch and wait and see how the rollout goes. We know big employers are going to do it. They're going to take the jump. We know unions and where they're headed. We can learn a lot from watching how the rollout goes, whether it's a government issue in terms of the way plans are regulated, whether it's an issue of an exchange promoting that they're ready to go, and then day one they flip the switch and guess what? It doesn't work, which I anticipate will happen in many, many places. So I'm a big believer in this. I think it's a good idea to advise your clients. Remember, your clients are not the people who this is directed to. This is directed to the people who don't buy insurance. Your clients already buy insurance. So for them, I think take them to the path that makes them the most comfortable. They can't avoid it forever, and this is the way I've communicated it to my folks. You can't avoid this forever, but you can avoid it for a year and wait and see what comes down.
Right. Thank you, Jeff. Any comments?
Am I allowed to comment?
Yes.
I don't know if I'm breaking the rules or not, but, and I guess it's kind of a comment and a question as well. So, obviously the biggest change coming in January of 2014 is community rating, which impacts the under 50, the small group, as well as the individual. So Beth was saying, delay the pain. So is your perspective that regardless if it's small group or large group, that you're saying renew early? Because I might have a different opinion on that, small group versus large group, in that the large group, there isn't that much advantage in renewing early versus waiting until.
I agree with you. I should have
Okay.
been more clear. It's primarily focused towards the small group.
Okay.
And a lot of it may even be census driven. I mean, as we go to a 3-to-1 compression
Yep.
between the youngest and oldest, I've got one group where the youngest employee is 52 years old. I can guarantee you they're going to probably do better after healthcare reform. But when you consider what the manual rate increases are going to be in that small market, in the markets where I work, it's still, best case scenario, it's going to be a wash for a small group to stay in 2013 rates. But I do agree with you. It doesn't apply equally on large group.
Great. All right, well, we'll move on to the next topic. This is for George. With the employer mandate being pushed to 2015, what do you see happening when low-income, marketplace-enrolled subsidized employees are forced back onto the skinny plan or an affordable plan in 2015 so the employers do not get hit with the $2,000 penalty after being subsidized for 2014?
So, thank you for that question, Justin. I think I will caveat my response by saying that at Jackson Hewitt, we now, Brian and I, mostly are focused on individual enrollment. That's our bread and butter as a company. And so we're not as closely tracking, our finger is not on the pulse. So I think many people in this room may be closer to what your clients are thinking about doing in the coming months and over the next year or so. But I do have a few things. I can offer a few observations. I think one of the first is there's an implicit assumption in this question that the employer is going to stop offering coverage or does not offer coverage today, and that they'll put their people on the insurance exchange or potentially on Medicaid, depending on their household size and income. I think that possibly makes sense for a large employer, an employer with more than 50 full-time equivalent employees. That might make sense if they don't offer coverage today, and maybe buys them a little time and saves them some cash. But for an employer who's already offering coverage, the administrative complexity of stopping offering coverage, moving all their people onto the exchange, and actually getting them signed up on the exchange, and then moving them back into a new plan, that sounds like I'm not sure about the strength of the value proposition for an employer. I think it's much more likely, and we have seen good evidence, that many large employers are manipulating hours in anticipation of the rollout of the penalties in 2015. That is to say, they're moving their low-income hourly employees who are working somewhere on the order of 30 to 35 hours a week. They're pushing them down in the 28, 29-hour-a-week range, which, of course, under the implementing regulations in the IRS, makes them a part-time employee and not subject to the Section 49 ADH penalties under the Internal Revenue Code. Another thing to consider, though, of course, is the other side of the equation is what does this look like for the employee? And if you want to talk about something that's hugely disruptive, the transition from employer-sponsored insurance to exchange back to employer would be a nightmare scenario for employees. I think that a wise employer would probably want to take a more consistent approach and you can by and large do the analysis yourself now about whether or not the penalty, it's worth it to take the penalty or not. And I think that anybody who moves their employees to the exchange with the idea they're going to bring them back onto employer-sponsored insurance is probably asking for an awful lot of trouble without a lot of payoff. But that's my opinion, and I stand to be correct.
Great response. Any comments on that? All right, we're moving right along.
Do you hear anything from your clients about? I mean, is this a strategy that any of your clients have talked about or considered?
I've definitely talked with some clients who are looking at the income levels of their employees and saying, you know what, I'm offering these people coverage today, but when I look at it from an employee perspective, they can do better on the exchange and get a subsidy. So maybe as an employer who's thinking about my employees, maybe it makes sense to kind of carve out, somehow create a class of employees and they're no longer covered by my plan and they can go and do what's right for them. So, I mean,
You mean like spouses?
Yeah, so it could be spouses, or they say, you know what, I'm gonna, I don't know, they risk the penalty, or I don't know, they're trying to figure it out. They are trying to balance that piece, but I've definitely heard employers say, specifically spouses, I'm gonna drop spouses because they can do better on the exchange. It's a tricky balance. I mean, it's for an employer, it's a yes/no question with the gray area that you mentioned of change the hours around. And you know, when there's change like this, there's going to be quote-unquote winners and quote-unquote losers, and you got to do the best you can to balance it. And you kind of have to look at it a case-by-case situation and figure out what is the client trying to achieve. You know, what's their perspective? Are they focused on financials? Are they focused on their people? And you got to work with them. There's going to be a lot of consultation over the next 12 months with the clients.
Yeah, I think the fear is the unknown. So if you are that employer and you've got low-income workforce and they do qualify for subsidy, at that point in time, you have to decide strategically that when the penalties do come back in 2015, how that's going to impact your workforce and disrupt workflow and productivity measures and those types of things. So I think it's important that if you run across somebody, an employer that's not having that discussion or hasn't had that discussion, it's a great opportunity to let them think about that from a strategic perspective and move forward.
Just one other comment about
Yeah,
that.
Jeff?
You know, I had a scenario run by me recently where, because of all the various rules, a family of 5 ended up in 4 different plans. Now, you know, that may be okay to a bureaucrat, but you people are in the field and deal with employers and employees every day, and if any of them would have ever asked an agent about the viability of that and how that will work for employee members, you know that it's going to be way too confusing, and the family is never going to be able to even keep track of which card goes to which person. And I think that's going to be problematic as well.
Question in the back.
Do you think the subsidized amount that the employee will receive is going to make up enough to offset what the employer was paying prior? See what I'm saying? That, I've heard they're doing in the marketplace is going to be very expensive, so therefore, will they really come out better in the marketplace, or do they have?
I think that's part of the consultative advice you have to look at. So one of the differences on a subsidized plan is you could have a potentially richer plan than the employer's going to offer. The employer could offer you a 60% plan, which is technically affordable, but they actually can't use it because the deductible is so high, and they can't afford to manage that deductible. Where if they're on a subsidized plan, it potentially is a little richer, and they can manage those costs better. So there isn't a yes/no answer. You really have to look at what's being offered from the employer, what are they looking at from the exchange, how does that compare, and what's the subsidy that they're getting. I mean, that's, we're going to start seeing what the rate, yeah, exactly.
That's
You're
right.
going to start seeing what the rates are going to be on the exchange, and that's going to give you the data that you need to help think through that.
But in any event, if you go to the calculator that's available to use on any one of a number of different websites, and if you plug in salaries and ages and information, you'll see, I've done it for a whole number of different scenarios, and the largest subsidy is for an employee age 55 with family who earns $90,000 a year. That's the biggest subsidy. If you're in your middle 50s and you earn $90,000 a year, not 91, but $90,000 a year with a family of 4, your subsidy is going to be somewhere in the neighborhood of 65 to 75%. So it almost doesn't matter at that stage what the rates are. 65% subsidy is going to be a good deal no matter how you boil it down.
I think it's important to remember that we actually know exactly what, if you could tell me the household size and the income
Right.
of a family, I could tell you exactly, with a calculator,
Right.
could tell you exactly what their premiums would be in the exchange. It doesn't matter what the total premium is, because if they're tax credit eligible, this only applies to tax credit eligible, but if they are tax credit eligible, and we'll I think we have a question later on about how the premium subsidy works, how the tax credit works. But if you can tell me those pieces of information, the amount of tax credit is just the total premium minus a contribution requirement from the family, which is set at a fixed percentage of their total modified adjusted gross income. So although we don't know what the total premiums are going to be in the market, we know exactly, based on household and income, what the premium would be, obligation would be for a family. So, and the other thing to remember is that it's not just the premium subsidy, there's also the cost sharing subsidies. And like Kari was mentioning, there may be a much richer, if an employer is going to offer a 60% AV plan, but I'm at 180% of the poverty level with a family of 4, so I'm making somewhere on the order of $35,000 a year, $40,000 a year, I'm gonna, which is a pretty average income in our state, I'm gonna qualify for a cost sharing subsidy that might move the actuarial value of my plan up to somewhere in the 90% AV range. So very rich benefit and a very low deductible. So those, when you do the cost benefit analysis for your employees, the if your employees fall in that 100 to 250% poverty level range, the cost sharing subsidies are very compelling benefit, and definitely something you want to also weigh in the balance.
All right. Any other comments on that? Great. We'll move forward. Thank you all. All right, Kari, this is yours. In the fully insured group market, the maximum deductible in 2014 is said to be maxed at $2,000 thereabouts. What are some options for these groups, i.e. level funding, dropping the health plan, raising employee contributions, et cetera?
So the $2,000
In 30 seconds.
The $2,000 deductible cap is again for small group, which for 2014 is under 50. And there's definitely two issues with that limit. There's an affordability issue, as you all know. You drop the deductibles, your rates are going to go up. And there's also a move away from consumerism. So a lot of companies have embraced consumerism, which has meant higher deductible plans. And Buddy's going to talk about that in the next question. But there are a few options out there, some more appealing than others, I guess. The biggest one being self-funding. So Justin mentioned level funding, which is a type of a self-funded product. But this limitation, this benefit design limitation, does not apply to self-funded plans. So if you have an employer who's interested in maintaining a higher deductible, they can consider a self-funded plan and design it with a deductible that they would like to maintain. So that does address the affordability question as well as some of the consumerism things. You can move to a self-funded plan, and there, Cigna obviously has self-funded options for smaller employers, and you'll see more products popping up from our competitors as well. So it's not just Cigna who believes this is an option. It's a lot of other carriers are considering it as an option as well. In the parenthetical comment Justin had in there, so you can look at raising the employee contributions. But that is it doesn't really address the affordability problem. Your plan is expensive, and now you're just shifting the cost over to the employees. Mm-hmm. And you might end up in a situation where your participation drops, and then you're going to have trouble getting something renewed, and you could end up being in somewhat of a death spiral because only the sickest people who need it stay on the plan, and your rates go up even more. So you got to watch the employee contribution approach to that. Another model that is starting to pop up, and I think there's a question on this later on, is a defined contribution approach, where the employer basically pays for funds, is what I'll use. They fund an amount to each employee, and then the employee can go out and get their own coverage. So that way the employer controls what they are paying, and then the employee is kind of empowered to go out and select what the coverage is that they want. So I think we'll see some more of that coming out in the small group market as well. And I don't remember whose question that is, but I think that's later on. And then obviously there is the opportunity of you can drop the plan entirely. That is an option. For a lot of under 50 employers, I think that they may seriously consider dropping the plan. And that creates challenges for you all in the room. That's when you have to kind of look at how you can convert them into individual consumers or individual customers. But from an employer perspective, they offer, the one thing you have to sit and talk with them about is why do they offer it today? And so they've made decisions all along, I'm going to offer a health coverage. Why is that? For some people, they just did it because that's what everybody did. For some people, it could actually be an advantage, so they use it as a recruitment technique. Like I have a very rich benefits, and that helps me draw the best talent. If that's a situation for your client, then dropping the plan may not be a good option, and you may need to look at some other things. So you have to really look at what the risks are of dropping the plan and what that means to the client as you're making those decisions. So those were the responses I had on that.
Great job. Thank you, Kari. Any comments on that? I think that's the biggest fear for our group is what happens to small group. Are they getting pinched out, and what are some options for them? So that was a great question from our membership. All right, we're going to move on to Buddy. Our high deductible, qualified high deductible health plan, HSA plans going to fade somewhat in the under 50 market due to the $2,000 maximum deductible. And how do you see the role of HSA plans changing under PPACA over the next few years?
Where's the crystal ball?
Here it is.
Well, first part of the question is, our high deductible health plans and HSAs going to fade somewhat in the under 50 market due to this push down to a $2,000 deductible. I do not see that happening. I'm pretty optimistic as far as what I've seen so far. First of all, HHS is modeling the individual, the small, and the large group after the high deductible health plan max out of pocket. So I see them looking to our industry and what we've been doing for a long time and how they are creating some of the benefit summaries that are out there in all markets, which is encouraging to me. I also understand that many of the carriers have given HHS some pushback on not being able to meet the bronze level actuarial value 60% by virtue of having this $2,000 deductible. And the encouragement again falls back on HHS coming back to the carriers and encouraging them to increase that deductible and bring those options back to the table for approval. So I see some leverage and opportunities there in our current model in the under 50 market, where I believe we're going to see deductibles exceed this $2,000 threshold come in the near future as early as next year. The overall success that we've had in HSAs in the last 7 years, we've trained the public to participate in these type of programs. The billions and billions of dollars that are in the market in HSAs they're going to be a lot of pushback from the consumers out there to continue to want to have this opportunity available in our marketplace. The second part of the question is how do you see the role of an HSA plan changing under PPACA in the next few years? I really can't speculate on 250 and beyond. All we can really look at is what is right in front of us. And I'm encouraged again by the previous comments I've made in the direction that we are going in. The out-of-pocket is still $6,350 for the many clients that we have out there that have a $2,500, $3,000 deductible with an 80/20. I still feel like price, when you start bumping that up to $4,000, $5,000, $6,000 and you bring the deductible to $2,000, $2,500, I still think we're going to have some opportunities out there to be delivering to our customers.
Thanks, buddy. Comments? All right, we're going to kind of move into a similar question for Jeff, and this goes around a lot of the questions that we've got as it relates to safe harbor and how an employer is measuring affordability using the employee only. So this question is, if an employer offers affordable coverage to the employee but chooses not to offer any assistance for the dependent coverage, will the family members of the employee be eligible for a subsidy?
This is one of the only questions. It's a very simple one. It's a one-word answer. No. Now, as you think about it and try to work out the philosophy about this, it's no surprise that UPS just announced that they're dropping all spousal coverage. It's no surprise that IBM just announced that they're going to terminate their retiree plan and move everybody into the exchanges. It's no surprise that these kind of things are going to occur. But then now where does that person stand? If they would otherwise qualify for a subsidy, but now can't get it, how does that affect them? How does it affect them having to go out and get other coverage for their dependent members other than inside the group? Great for individual plans, but very complicated for employees, and it's hard to say what the financial impact of all of that is. It's hard to say whether it would have been a better deal this way or that way. We don't know all of that yet. It's again, it's going to be part of the whole learning process of trying to analyze this for all different types of employers. The consultative work that we're going to need to do in the future years is going to be far and away more important than the selling work. The selling work is pretty much being done for us at the point that we no longer have to worry about being turned down in underwriting for jet lag, which is great, but it's going to be complicated for both the employer and the employees. But the answer to the question is a simple no.
Okay. Thanks, Jeff. Comments? Yes, sir.
No, the way the rule works, it's actually not an IRS rule that's driving this. It's a Health and Human Services rule. And what it says is that on the affordability test for employer-sponsored insurance, if you have an offer of affordable coverage that meets minimum value, you're ineligible for tax credit. And the way they look at that, they vacillated for a while and actually reserved publishing a rule on it until not too long ago. But they decided that they would evaluate the affordability for related individuals, that being dependents, be they spousal dependents, or you know, whatever, whoever you're claiming a deduction for on your taxes, or an exemption, excuse me. That the affordability for those related individuals would be based only on the employee-only portion of the premium and the employee's contribution to it. If that's less than 9.5% of the household income, then it's an affordable offer of coverage. So there's no tax. There's no short of getting divorced. There's no good tax remedy to this. This is something that really concerned us when we were working for the governor, and we came up with a number of. You all know Brian. We came up with a number of kooky ideas, none of which saw the light of day, but one of our favorite solutions was to have an employer, when you're talking about are you better or worse off as a family or as an employee, family of an employee, one of the ways you could theoretically allow your employee's family to figure out and make that decision on their own, assuming you're under 50 and you're not subject to a penalty, so you're agnostic about whether or not they take the subsidy or not, would be to offer 0 contributions to the employee, but full contributions to the family component of coverage, and thereby skirt the whole issue and make them, if they're better off in the tax credit program, they would be eligible because it would be an unaffordable offer of coverage for the employee, so they could take it. If they would have been better off on their employer's plan, they could always take that and simply pay the employee portion, have the other portion paid. So that was, you know, there are some creative things you could do. I'm not telling you should do that. It would be very difficult to explain to your employees, I think, and to your clients, but there are some ways around that.
Right.
But if you don't offer it to the spouses, which is something we talked about before, what does that mean for the spouse, like for the tax submission? I think that was kind of getting at your question. Do you have to submit taxes differently to get that, or is it not?
No, you'll still be required to get a tax credit. You're required to file married jointly if you are married. So you'll still file married jointly. What will happen is you'll only be applying for a subsidy for the spouse, and so you'll apply as a household, and the employee member of the household, whichever spouse it is, will be ineligible for the tax credit. But if there's no offer of coverage to the spouse, then depending on their income and household size, if they fall between 100 and 400% of the poverty level, then they would be eligible. But you still apply, you still file married jointly, and you still apply as a household.
Great.
So this does have some important tax implications, and if that child, this is becoming less and less common, but if that child were at, say, the age of 24, totally independent and filing their own taxes, that child would be part of a separate household, and therefore could apply to get a subsidy on their own. If, however, the parents are providing support to that child and they're not fully independent and they claim an exemption for them, they're part of their parents' tax hold, and they would have to they would have to be treated together. I haven't looked at this in a while, and unless there's been a rule change, I believe that not only that while employers can drop the spousal coverage option, I believe that under Section 4980H, they are required to offer dependent coverage. So again, the dependents are caught in a trap, and it's mostly driven by the tax status of the household. If the child is no longer a tax dependent, then they can apply for the subsidy. If they are a dependent for tax purposes, then they're part of the household, and they would still be subject to the employer's offer of coverage to them, and which would potentially make them ineligible for the subsidy.
Right. That might bring us into our next actual topic. So we can bypass it if we don't want to discuss it too much. This is back to George. How do advanced premium tax credits work and the issues surrounding who is a good candidate for the marketplace? How would you help a consumer understanding the difference between subsidies and cost sharing is probably more of a new topic, that second bullet.
So I mean, we already talked about the tax credit is driven by a pure calculation of your income times a certain required contribution percentage, which is on a sliding scale from, I believe, 2.2% to 9.5% of income. And then whatever that number is what you've got to pay. And the difference between that number and the total premium is your tax credit. Now, as you know, you can take that tax credit, which is based on the second lowest cost silver plan in your rating area. You can buy up if you want. You can buy a gold or platinum plan or a more expensive silver plan. You can also buy down. And the marginal dollar that you spend, in increase in price if you buy up, is spent by you, the individual taxpayer or tax credit recipient. And likewise, the marginal dollar that's saved by buying down, because the credit remains static, remains the same no matter which direction you go, the marginal dollar that you save by buying down into a bronze plan, you save every dollar of it. So Treasury's obligation, the Department of Treasury's obligation to you remains static no matter what you do. So the tax credit has lots of interesting sort of there's lots of interesting little things we could say about the incentives that provides to people. The biggest one being that what we used to call $0 bronze, and it relates to the reason it's interesting is it relates to the cost sharing subsidies. The cost sharing subsidies, the premium tax credit can be used in any metal level tier, through bronze, through platinum. The cost sharing subsidies are only available in the silver tier. And so for taxpayers with household income, with federal poverty level, household size income, federal poverty level between 100, 200%, 250% of the poverty level, where you're eligible for the cost sharing subsidies. If you buy down, you might have a very low premium obligation, might even be zero, hence $0 bronze, because you get that whole silver level tax credit to buy down. So you might have no premium at all, but you might forego significant cost sharing reductions. So although you might save $80 a month and have no premium obligation and get free health insurance, you might go from a 95% AV plan, with a $180 deductible, to a 60% AV plan with a several $1,000 deductible. So that's going to be difficult to explain to people, and frankly, the only people in this state who are going to be able to explain that to consumers is you guys, and maybe Jackson Hewitt. So if we do our jobs. But I'm being tongue in cheek, but so there's lots of interesting things we could talk about on the tax credit side, and I'd be happy to do my best to answer them. I think the second question is actually a really interesting and important one, because for most of the people entering this new marketplace, they're really not familiar with insurance products. They don't have a ton of experience with them. It's an abstraction for them. It's a financial instrument, and these are not terribly sophisticated consumers. So there's going to be a lot of confusion, and talking about things in a way that people can understand and relate to them is going to be essential. one of the things that we a principle that we held fast to at the state, and will continue to do so at Jackson Hewitt, is we do not feel bound to talk about things in the terms that the federal government has set them up in, right? The bureaucrats in Washington have decided that this metal level thing makes sense, and bronze, silver, platinum, gold. I don't know that most low and middle income people know that platinum is more valuable than gold, and gold is more valuable than silver, and silver, I don't know that that's true. And so what we talk about is we just show plans, right? And so the example I talked about where you go from a 95% AV to a 60% AV, you don't explain that to them. You don't say, well, you get a cost sharing subsidy in this one, but you don't in that one. You just show them both and say, look, you've got a really low premium, high deductible here, which means if you get sick, you're on the hook for the first, however many $1,000s. Here, you're paying $45 a month, but if you get sick, you're golden. You've already paid for it. And so talking about things in ways that people understand without feeling bound by the terms that the federal government has defined them in, I think is important, and you should not feel obligated to speak the bureaucratic language, but rather speak the language that you think your clients best understand. And I think that's a really important point.
Yeah. Well said, George. Any comments on that up here?
On the premium tax credit, supposedly the IRS is going to pay the insurance company. How easy is that going to be to set up? I don't expect that's going to happen. The insurance company will be paying. How are they going to? Is that just going to be a blocky check? It's like I want monthly premium paid, and I'm going to wait to rectify it when I file my taxes. How's that going to work?
There will, the federal application for eligibility, the paper application is out. It exists. It's this much touted 7-page application that really is still the old 21-page application. They just took all the household members out of it and said they shortened it. But it's not entirely clear what the federal portal will look like for buying these products and selecting them and then making the election about how much of the tax credit you will use. I've heard very recently that, for example, that the state exchange in the District of Columbia will default its customers to only claim 85% of the tax credit up front going to the insurance company. And the reason they've done that is because, as you know, the tax credit is based on an estimate of income. And when you come back next year to Jackson Hewitt, like you all do, like everybody does, to reconcile that credit against your actual income, if your actual income was higher than what you estimated it to be, you'll have a repayment liability. And the liability is capped at, depending on who you are, at different levels, but it's coming out of your refund. And likewise, if you overestimated your income and you wound up having lower income actual relative to estimate, you might get a little bump. You will get a little bump on your refund. So the reason that the DC exchange has decided to default everybody to 85% of claiming 85% of the credit is to essentially they made a paternalistic decision to give, and I won't comment on the wisdom of that, but just to say that it's a significant issue and one that we're also concerned about for our customers, is that the reason they've done that is to give them, it's basically like an insurance policy. And they're hedging that 15% with essentially withholding on the tax credit will be enough to cover any repayment liability that somebody might have down the road when they come to reconcile their tax credit in the next year. So somewhere on the federal portal there will be a page where it will say, how much of your credit would you like to claim this year? And there is no telling how few people will actually understand what they're asking. I mean, if 1 out of every 10 people understood what that page was asking, I would be shocked. So that's going to be a huge issue for you guys in your conversations with clients. If you do have clients who are claiming the tax credit, to advise them about that repayment liability or to send them to Jackson Hewitt to discuss the tax ramifications of it, I think is going to be really important. But somewhere on there, you'll be able to elect You could claim 0 or 100% or anything in between.
Great. Thanks, George. We're going to switch gears a little bit, knowing that we've got to balance the audience here. We've got some folks that are focusing on the revenue-generating opportunities of the individual marketplace, but also we've got some folks that have some larger groups that want to talk about self-funding and some strategic maneuvers in that respect. So we're going to go back to Kari, and the question for you is, do you see more mid-market size groups moving to self-funding? At what size segment do you see a migration towards ASO services increasing?
Okay. So we have already seen growth in the self-funding for smaller employers. So again, I serve employers with employees 25 to 250 employees, and at Cigna that's a designated segment across the country, and we have seen significant growth in our self-funded products. As part of our new sales, it's up to 40% of our new sales in that segment. And that's just on the merits of self-funding alone, regardless of what the benefits are that are coming, additional benefits that come with PPACA. I was trying to do some research before this to see if I could pull like Cigna agnostic stats on what the growth has been in self-funding for smaller employers, and I did find one that said if you look at the population under 200, which does include obviously the under 50, the number of employees who are covered by self-funded plans was at 10% in 2003, was at 15% in 2012. So doubled in growth over those years. And again, that's based on the merits of self-funding alone, which a lot of that comes down to the transparency that comes with the product. So you have full claims information, which can then help you educate your employees, guide you towards health improvement programs, that kind of stuff. It also gives you better visibility into what the renewal is going to be. So it just gives you a lot more data to be consultative with your clients. It helps keep your clients engaged in their plan and help them figure out ways to control their costs. That's been a big play, as well as for a lot of folks, they find that the flexibility of the benefits that a self-funded program offers them, that has been a draw. So you can have the same benefits across state lines. Some of the state mandates don't apply when you're self-funded. So there are a lot of merits to self-funded, even in the smaller groups without PPACA. For the under 50 market, we did, regardless of under 50, PPACA brings a couple more advantages to self-funding. So on the small group side, we already talked about the $2,000 deductible, which doesn't apply to self-funded products. Also in the small group, community rating doesn't apply to self-funded products. So we will continue to do full underwriting under 50 if it's a self-funded product. So if you have a group that is going to get hurt from a community rating standpoint, potentially a younger population, then self-funding could be a really good option for them. In terms of the larger groups, one of the biggest savings with PPACA is the health insurance fee, which is estimated to be about 2.5% to 3% of premium this year and growing, and that's a tax or a fee that doesn't go away. It doesn't have a deadline at this point. That does not apply to self-funded plans when it does to fully insured plans, and that's true for all size segments. And then another one more on the larger side, and this kind of constraint gets a little bit confusing, but from a large group employer, they're not forced to offer essential health benefits. But if they do, they have to meet the requirements of the state. And we have learned that some of those requirements can be pretty cost inhibitive, I guess is the right word. But with a self-funded plan, you can say, I'm going to pick an EHB. This is how Cigna's describing it. I'm going to pick an EHB state, so my essential health benefit state. So I'm going to say, I want that state because it has the loosest requirements around essential health benefits. So I'm going to be situs in Tennessee, but I'm going to pick Wyoming as my EHB state because it's going to give me the best flexibility in the benefit design. So that's an option that you have with self-funding, different than fully insured with, after PPACA. So there's definitely some advantages to the product in and of itself, plus some additional ones with PPACA. And then the second question was, what size segments do I see this migration happening? And again, we sell it down to 25 lives. 25 enrolled. We feel that that's a reasonable cutoff to be self-funded. But I have another question that's coming up in a few questions that talks about what are some of the pitfalls and concerns around self-funding for smaller employers. So it's not a product for every client. And so there are things that you need to understand around a self-funded product and what it means and what does that mean for the client. So